I want to start with a number.
John, Lisa.
Negative 77 basis points on the yield curve in America, the 2-year versus the 10-year. And I want to understand from your perspective and the team at PIMCO. Tony, how much signal can you take away from that yield curve right now?
Well, there's a significant amount of signal in the yield curve. It's a reliable indicator, as you know. But that number you referenced, John, is similar to what's called the term premium, which is the difference between the future short-term interest rates and that long-term rate. Typically, there's a term premium in a long-term interest rate, meaning that an investor says it wants additional yield for stepping out on the yield curve because there is more risk in stepping out on the yield curve. But these days, and for a long time now, the last 6 years, especially the last decade, investors haven't demanded much in the way of a term premium. Is it related to the Fed? It could be. Think about it this way. We know that lots of shelves were cleaned out during the pandemic. We saw supply chain problems, some stuff missing. There's still stuff missing from the shelves in the sense that the Fed took a lot of bonds off the shelves, trillions of dollars worth. It's only putting a few back at a time. So that keeps the term premium suppressed. So there is a bit of a distortion in that sense, but markets clearly are deciding that there are risks, elevated risks toward recession next year.
And Tony, a lot of people are going into longer duration because they do see the proposition of growth over the longer term really coming down dramatically. We were talking yesterday with Brian Weinstein of Morgan Stanley, and he said he could see a 3.25% 10-year Treasury yield before this rally is over, and he could see that yield curve inversion going to negative 125 basis points. Do these potential outcomes seem probable to you?
It is possible. Tara is the new investment mantra, in fact. A lot of investors are talking about the idea that there are reasonable alternatives rather than the old TINA. TINA's exited. Tara's entered the building. TINA was that there is no alternative. Now that yields are up, there are. Now, think about it this way as well. The boomers are aging. 1957 was the biggest birth year last century, so this year is the biggest year for retirements in history. This wave lasts through 2030. Think of the boomer mentality in the 2010s. They probably thought they'd never, ever see interest income as part of their future earnings story, but now they do. And so they will keep pushing back, you could say, on these higher yields when they happen, because they'll say, well, thank goodness, now I can rely perhaps on interest income. Plus, there are numerous other reasons why investors might want fixed income. And so they could push into yields. What I'm trying to say is that there will be non-economic reasons in a sense, but it's economic, of course, if you're a retired individual, for wanting to explore fixed income today, because there are reasonable alternatives and yields do look good relative to future inflation, relative to the long-term average, and as a hedge against future recession risk, because bonds do tend to outperform equities and credit in cases like that.
So what's your highest conviction move ahead of next year, especially given that people are already rewriting their 2023 outlooks?
The biggest area of conviction that one should have entering 2023, and it isn't easy, is to expect that interest rate volatility will plunge next year relative to 2022, because the forecast miss on the federal funds rate is highly likely to be a lot smaller next year than it was this year. The Fed, others expected the funds rate to end at 1%. It's ending near 5%. What are the odds of a 4-point miss next year? What if it's 1 percentage point miss next year and the markets think it's a 6% funds rate instead of 5%, where it's priced now? You'd see the type of repricing in markets that you saw most of this year, but it probably wouldn't go that far, because it seems like between the three Fs, the Fed, fiscal policy, and financial conditions, it will be enough to cause meaningful disinflation, and that therefore the lower interest rate volatility will benefit lots of assets, agency mortgage-backed securities for one, ultimately credit, ultimately equities, et cetera. But the real volatility might be in spreads in the bond market, not in interest rates.